Ladies and gentlemen, good day and welcome to Suryoday Small Finance Bank Q3 FY22 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pritesh Bam from DAM Capital. Thank you, and over to you, sir.
Hi, good morning, everyone. On behalf of DAM Capital, I would like to welcome the MD and CEO and other senior management members of Suryoday Small Finance Bank. We will have brief remarks and presentation from the management team, followed by Q&A. Now, I would like to hand over the call to Bhaskar sir. Thank you.
Thank you. Good morning, everybody. On behalf of Suryoday Small Finance Bank, I extend a warm welcome to everyone to this Q3 and 9-month ended December 21 FY22 earnings call. At the outset, I hope that all of you and your loved ones are safe and doing well. During the quarter, we saw a stable business recovery and are hopeful that it will progress to exceed pre-COVID levels in the coming quarters. The company is optimistic about growth due to tailwinds, coupled with opening up of the economy, and believe that the worst is over and things will return to normalcy from Q1 of FY23. I hope you all have received our revised investor presentation and had the chance to go through it before the call. I will give you a brief highlight of our performance for the quarter and for the 9-month period ended. The bank disbursed 1,121 crores during Q3 FY22 compared to 1,066.9 crores in Q2 and 785 crores during the Q3 of FY21. The cumulative disbursements for the 9-month period stood at 2,547.6 crores, up by 119.7% on a YOY basis. The company employed a cautious and calibrated approach in disbursing loans to new customers throughout, emphasizing more in disbursing loans to existing customers with regular repayment cycles with us and also with a healthy credit history with other lenders. The focus is on retaining microfinance clients who have exhibited good repayment behavior while also onboarding new customers in the micro as well as in the non-micro loan segment, and specifically expanding the affordable home loan portfolio and secured business loans. On the collections front, for the month ended 31st December, the bank's one EMI adjusted collection efficiency was 84%, marginally higher than 83% for the month ended 30th September 21. In December 2021, overall collection efficiency was 109% compared to 108% in September 21. Our gross advances grew by 25% to 4,872 crores on a YOY basis. At the end of December, inclusive finance constitutes 67.3% of the book, while affordable home loans, commercial vehicles, and secured business loans comprise of 8.4%, 6.8%, and 4% respectively. In the next 2 to 3 quarters, Suryoday plans to maintain a portfolio mix of 60%, 40% towards inclusive finance and non-inclusive finance loan segments. We are targeting a growth rate of 25% during this financial year and targeting a growth rate of 30 to 35% in FY23. Our total deposits declined marginally by 5% to 3,170 crores as on 31st of December. While there was a degrowth, the granularity in our deposit base increased significantly. Retail deposits formed 88.4% of the total deposits on 31st December compared to 72.4% during 31st of December 2020. The balance comprising of bulk deposits. Furthermore, 100% of our bulk deposits are non-callable in nature. Our CASA improved to 19.2% as of 31st of December as compared to 13.3% during the same quarter previous year, resulting in steady improvement in line with our strategy. Retail deposits grew by 15.7% in Q3 on a YOY basis. Similarly, bulk deposits have reduced substantially by 60% in QY FY22. Savings deposits increased by 38.9% and current accounts balances increased by 18.5% during the quarter. Our borrowings as of end of December constituted 31.8% of our total liabilities, majority of which is 87%, was from refinancing institutions. Our bank has also drawn down SLTRO limits to an extent of 750 crore for a 3-year tenor at 4% per annum fixed rate of interest, which will further reduce our cost of borrowings. At the end of December 21, we had a total branch count of 564 branches, out of which 97 branches were primarily liability focused, while 360 branches were primarily asset-focused branches and the balance comprising of rural centers. Through this branch network, the bank services 18.5 lakh customers, of which total asset customers are 16.2 lakhs and the total liability customers are 11.6 lakhs, and the balance being unique customers. GNPA as of 31st of December stood at 10.5% compared to 10.2% as of 30th September. Our net NPA stands at 5.6% as of 31st December. Net NPA excluding ECLGS loans stand at 4.8% as of 31st of December. Our provision coverage ratio for the quarter ended is at 67.9%, including tech write-off. Delinquency in the portfolio marginally increased due to the impact of the third wave of COVID during the month of December. Collections were difficult, however, customers are in touch despite the COVID wave. Our 90 plus portfolio as on 31st of December stood at 4.6% of the overall loan book. Our total standard restructured pool currently is at 11.9% of our advances. The collection efficiency on the restructured book currently stands at 65%. We continue to monitor restructured portfolio for our clients. On the earnings side, our net interest income increased by 52.6% year-on-year to 167.3 crores, and net total income increased by 37.6% year-on-year to 193.4 crores. Our NIM currently stands at 9.9% for the quarter ended Q3 FY22 compared to 9.1% for Q2 FY22 and 7.4% in Q3 FY21. Other income mainly included income from sale of investments of rupees 8 crores. Our cost of funds reduced to 6.8% in Q3 FY22 compared to 7.1% in Q2 FY22. Cost to income during the same period moderated to 66.6% compared to 65.7% in Q3 FY22, which was primarily due to rise in income coupled with a lower cost of borrowing. The company incurred a profit of 4.7 crores in this quarter as against a sequential loss of 1.9 crores in Q2 FY22. Our PPOP increased from 48.2 crores in Q3 FY21 to 80.5 crores in Q3 FY22 at 67% increase. Excluding MTM, the PPOP was 36.5 crores in Q3 FY21, increasing to 91.2 crores in Q3 FY22. As of December 21, we continue to hold a floating provision of 91 crores on our books. On the capital adequacy, we continue to maintain high capital. As of 31st December, our capital adequacy of our bank was 41.4% compared to 41.1% as of Q3 FY21. Our Tier 1 comprises 37.8% and Tier 2 comprises 3.6%. We have managed our liquidity prudently, and from peak liquidity of 1,684 crores in June 21, we have brought this down to 650 crores as on 31st of December 2021. There is a significant thrust on the digital front with launch of technology transformation program Pragyan, which we are migrating to a new CBS platform, Infosys Finacle. We are planning to complete this exercise latest by FY23. We have done a collaboration with fintech companies to leverage digital partnerships to provide value-added products, and currently we have lending programs with Paytm and Lending Card. The overall digital transactions have been increasing sequentially with the rise in UPI transactions as well as online transactions through our net banking. Just to summarize, the business has witnessed a moderate impact of Omicron variant of COVID. However, we see a clear indication of stability and growth and reaching pre-COVID levels. Our endeavor is to maintain a consistent 25% growth, which we'll see in the year FY22 and marginally increase in FY23. The company plans to scale up our affordable home loan and MSME book in the future, specifically secured business loans. So we plan to achieve 400 to 500 crores of monthly disbursement run rate from Q2 of FY23. On the deposit front, we foresee great opportunity in leveraging our JLG customers and offer them our liability products. We would expand our branch banking network meaningfully. Suryoday aims to expand its presence cautiously in new states and strengthen our foothold in existing states. Going forward, we plan to target 40 crores of PPOP on a monthly basis from Q2 FY23. Funding has been rationalized through SLTRO lines borrowing, and the cost of funds is expected to go down further in this quarter. No impact of legacy portfolio is likely to be carried forward beyond Q1 of FY23. We are confident that with a focus on good governance and solid regulatory compliance, both in letter and spirit, and with customer focus, including deepening our relationship beyond microfinance loans to our core microfinance customer segment and impactful digital initiatives, build a very respectable and sustainable profitable bank. Thank you, and over to you for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. Our first question is from the line of Renish Patel from ICICI. Please go ahead.
Yeah, hi sir. Good morning and congrats on a good set of numbers. So just a couple of things. So one is on the PAR portfolio. Industry has been now sort of approaching towards the sort of 10-15% kind of a PAR 1 plus portfolio, wherein we are still at 22%, reflecting marginal sequential improvement. So, sir, what are the primary reasons for such a sticky PAR 1 plus portfolio for us?
As a policy, given that our majority of our segment is in the inclusive finance portfolio, our approach to collections, right from since inception, has been in terms of being in touch with the customer and enabling the customer to pay without exerting any pressure. This is not a commentary on the competition, and with this, our focus has been, by and large, even including the severe COVID wave 1, was to be in touch with the customer and tell them that we have their backs, and that kind of we are continually kind of there to enable them multi things. So our overall, including in our own collections policy, is that the intent is to get the customer paying on a month-on-month basis regularly, and to that extent, the PAR 1 may look higher, but on an overall basis, in terms of the portfolio, we measure our quality of the portfolio in terms of expected credit loss by the number of customers as well as the portfolio which is making payment on a continuous basis. Sometimes when the customer makes a partial payment, it will spill over into 1 plus, but nevertheless, they are not customers who either by intent or ability are likely to slip into credit loss.
Got it. So, sir, this 22% plus PAR portfolio, what could be the customer activation rate in that portfolio separately?
I would specifically on Q1 plus on space, we don't have the immediate numbers, but overall on our overall portfolio, approximately closer to 450 crores of customers, which includes customers which are accounted for in GNPA, have not made payments in 2 sequential months in terms of November and December. Our intent is to really reduce this 425 to 450 crores of portfolio not made payment to it is accounted for in GNPA or it's already in 120 plus. To reduce this amount of kind of over, specifically in this quarter, spill over into next quarter by approximately 100 to 150 crores.
Okay. And sir, what is the write-off we took in this quarter?
Kanishka. Hand it over to Kanishka first.
For this particular, hi, good morning. For this particular quarter, we have taken write-offs of 93.4 crores.
93.4 crores.
Correct.
Okay. And sir, what is the total provisioning number for this quarter? I'm sorry, I just not able to recall that number.
So the total technical write-offs end of December 31 is 288 crores.
And the total provision this quarter we make is how much, sir?
Total provision for this particular quarter has been, we have made a provision of 75 crores for the quarter, incrementally.
Got it. So that's why there is a hike in net NPA?
Yeah, there has been a marginal increase in the net NPA, right? But overall, I think we have tried to be within the 5.5% number.
Correct. And sir, what's the let's say a sustainable PCR you would like to maintain on our kind of AUM mix?
Ideally, we would like to be closer to the 70% number, right? And that's what we would try to achieve definitely by Q1 2023.
Got it, sir. Yeah, that's it from my side, sir. I will come back in the queue if I have any other questions, sir.
Okay, just to add for the question that in terms of activation rate, 71% of our delinquent customers, which includes 1 plus, are activated customers, are the paying customers, which I think
Got it. This is very helpful, sir. Thank you, sir.
Thank you. Any participants who wish to ask a question at this time, they may please press star and one. A reminder to our participants to ask a question, please press star and one at this time. We have the next question from the line of Deepak Agarwal from Axis Mutual Fund. Please go ahead.
Yeah, good morning, sir.
Good morning, Deepak.
Yeah, good morning.
Sorry, Deepak, your voice is breaking. I request you to come to network area, please.
Sir, is this better?
Yes, slightly better. Please go ahead.
Yes. So basically wanted to understand now how should we look at FY23. One is in terms of growth and second in terms of the credit cost. Clearly we are seeing growth coming back. So any broad numbers we should work with kind of growth and credit cost?
So Deepak, we kind of seeing a pretty strong growth for this year. And based on our own detailed analytics and drill down, around closer to 25% of the microfinance customer are very strong, good customers for other secured products. And where at least the lady of the household herself is a co-applicant. And many of the products like two-wheeler, they may not be even be the co-applicants. So our focus for FY23 is to deepen our relationship substantially with our very good microfinance customer who have been with us for more than 2 years, which numbers to around closer to 6 lakh customers, displaying clear and solid intent as well as ability to rough out all the 3 COVID waves and are current with us. Based on, and we are also growing our affordable home loan and secured business loan portfolio, both to our existing customers. Existing customers could be liability customer, could be inclusive finance customer, could be MSME customer, increase the base and as well as kind of target new customer through our branch network. We have not activated our entire branch network for retail assets. The intent is to really take it at least to 100 branches during the FY23. So based on the current run rate of around closer to 350 to 400 crores which has been clocking and likely to be at around the same number a little more for this quarter, we project a growth between 30 to 35% in terms of assets. As far as the sticky portfolio is concerned, it was pretty volatile for a few quarters back. We clearly see lots of stability and activation happening out of customers who are not paid even for a period of 90 days or 120 days. The intent during this quarter is to activate furthermore closer to 100 to 150 crore worth of portfolio, specifically from inclusive finance segment, who have been either paid to us a couple of months back or currently paying to other lenders in the market through the credit bureau data which is available with us. Probably we have not been in active touch with them because they probably happen to be in centers where these customers, whether the centers have become inactive and the customers are few in number and the reach probably has kind of got missed out in the last couple of months. So we do not see any increase in the non-paying customers beyond what we have, which is around closer to 425 to 450 crores. And the intent is to reduce it by at least 100 crores during this quarter. And we would also make provisioning as required for this quarter. And as guided last time, we expect that the provisioning to be fully complete by in this quarter as well as a small spillover going into Q1 of FY23. FY23 as a year of, we see it as a year of enterprise profit. And we are kind of guiding ourselves around closer to 40 crores of PPOP from July. And with broadly the provisioning near complete, we would expect a substantial piece of this PPOP also to translate into PBT starting from July, August of FY23.
Got it. So anything on the partnerships, anything incremental to share? Obviously, we have shared in the past. Anything more, sir, on that? On fintech part?
We kind of growing there are two sets of fintech partnerships which are growing. One is on the lending side, which currently we have with Paytm and Lending Card. On the other side, we are working with a few fintech partners yet to really fructify into a relationship which will be on substantially on the deposit mobilization side. So given the changes in the overall regulatory environment and also the expectations from the regulator, specifically to comply clearly as a bank with KYC as well as in terms of credit decisioning, we are making our process far more robust to comply with the existing regulations, both in letter and spirit. And we believe that now we'll activate it, and the run rate from these partnerships is very strong during the previous quarter. This quarter, we are really relooking at it to strengthen it further, and we'll activate during this quarter and next quarter. But however, as a cautious strategy, our overall portfolio from these partnerships, specifically on the lending side, will be kind of not more than 5 to 10% till we really have a full-fledged experience in terms of at least a cycle going through what happens. But however, overall, at this point of time, the portfolio behavior as well as our own scale has been reasonably good. I think as of December, we have done closer to around 60 crores through this partnership in terms of our assets.
Got it. Thank you so much. Thank you.
Thank you. The next question is from the line of Varun Gaya from Dimensional Securities. Please go ahead.
Hello.
Good morning.
Yes, sir. So I wanted to know that your other expenses jumped around 15% quarter on quarter, around 10% year on year. So what has led to that increase? And secondly, how are the disbursements panning out in the Q4? Because major portion of third wave impact was post-January. So are you seeing further pressure on the NPAs in this quarter?
I'll answer the second question first and then request Kanishka, our CFO, to answer on the other expenses, the reasons for the increase. So in terms of the COVID-3, the impact was marginal as we speak now. Specifically in terms of Jan, around a couple of 10 to 15 days were kind of clearly impacted, both due to our own employees getting infected as well as a little bit of a small scare among the customers during that period. But however, as the month settled down, the impact was very, very marginal, or I would say that near close to nil. As a strategy, since given the little uncertainties of what could be the impact even in terms of an unlikely further waves, we are deepening it specifically in microfinance segment to our existing well-paying customer who have been with us for more than 2 years, which is a very large number at around closer to 6 lakhs. So based on all of that, and we have not been very aggressive in terms of increasing our disbursements, our run rate has been steady at around closer to 350-400 crores for both for Q2 and Q3. We would see the similar momentum for Q4, marginally maybe higher, but around the overall 1,200 to 1,400 crores is what we're really looking at. With the specific focus would be in terms of increasing our non-microfinance book. Even at the continuing run rate of 70% in microfinance and 30% in non-microfinance, given that the door-to-door of the microfinance is only two years, and the rest of the loans is minimum of around 4 to 7 years, depending on the product. So the tilt will be in favor of non-microfinance, even at this, to closer to 60 to 40%, 60% in terms of microfinance and 40 in terms of non-microfinance, specifically secured assets, by around Q1 and beginning of Q2. And the intent is to take it closer to 50%, probably by end of FY23.
Okay. And about the other expenses?
Hey, hi, good morning. Insofar as the other expenses are concerned, the increase has largely been due to payouts to our partners like Paytm, as well as servicing of collection service points with our partners.
So this run rate would continue going forward, or will it drop from here?
We expect an uptick in the partner programs, especially with Paytm. So there's likely to be an increase, but that will be commensurate with the increase in the fees that we earn from these programs.
Okay, got it. Thank you.
Thank you. Our next question is from the line of Rajat Bansal from Lok Capital. Please go ahead.
Sure, thank you. Good morning, Bhaskar and team. So my question is on the secured book that we have, primarily HL, small business loan and CVs. Can you talk a little bit about what are the customer segments we're going after here? What is typically the LTVs on these books, and what is the competition you're seeing on the ground?
Yeah, specifically, good morning. On the books, in terms of home loans, we have two separate verticals. One focusing on micro home loans, which are similar to our microfinance segment, which has got a total household income of anywhere between 30 to 50,000. One of the family members may be kind of formally or semi-formally engaged. That ticket size is around 5 to 10 lakhs, and that is mostly self-construction, where the LTV will be in the range of 60 to 70%, considering that they already own the land. It will be only for the construction in majority of the cases. In terms of the other regular affordable home loan portfolio, the average ticket sizes now varies between 12 to 15 lakhs on average, but the range of disbursement is from around 10 lakh rupees to around 35 lakhs. And above 15 lakhs is a very, very small segment, and LTV there varies anywhere between 80 to 85%, depending on the quantum of the loan. And in terms of secured business loans, we target to kind of have around 60 to 70% max LTV. However, for existing customers with various other relationships or substantially proven track record with an underlying established business as an MSME, we go up to even 75 to 80% in terms of secured business loans, where our entire secured business loan, our underwriting is predominantly on the underlying cash flows on the business and partially on the security. It is not the security first and the underlying cash flows next. And we have clearly implemented it and intend to kind of continue the same.
Sir, how about competition in these segments? Are you seeing more players getting into especially the small business loan segment?
Very true in terms of competition. But the fact is that based on our own, a substantial percentage of our existing customers, either liabilities or inclusive finance or retail assets, are customers for secured business loans, including in terms of a takeover. On a targeted basis, if you are able to reach out to the customer where you are originating rather than getting originated by the DSA, which means it's not just one DSA, it could be a couple of DSAs taking various, then the pricing becomes a primary point of negotiation. So currently, and also our cost of fund, we have brought it down, as you kind of would have seen, to 6.9%, which makes it meaningfully competitive to play by and large the entire gamut of spectrum, starting from if it is a loan against property of around even 10%, to a very well established with a solid track record and then very good underlying cash flows, to operating at around 14%. Our range currently in terms of secured business loans is between 10% to around 14%. In terms of regular affordable home loans, it's from 9.5% to around 12.5%. In terms of affordable home loan, it's between 14% to 17%.
Got it. And the experience on LGDs for especially the micro affordable home loans,
We have just started. It's a very, very small piece of portfolio, but the clear learning, if we have to migrate our experience from inclusive finance, it is that there has to be a clear, intense collection focus on a month-on-month basis. It cannot be treated like a typical retail asset where you expect a 80% check clearance. So here the check clearance initially will be around 55, 60%, but if you match them and create that behavior, since majority of the households where we are doing micro home loans have gone financially digital, not necessarily just the borrower, they happen to be the lady who happen to be the spouse, but the sons and daughters are moved on. Our focus is to really kind of make it as meaningful as in terms of repayment to the digital form right from the beginning. It's a question of in terms of creating that customer behavior right from the beginning. We do not see anything substantial beyond probably 1.5% LGD, because it's not sprinkled. It's not across the segment. We do a clear-cut analysis and then only fund, and the size is between 5 to 10 lakhs. If done well, I think it can be a less than 1% credit loss product.
Okay, sure, sir. Thank you.
Thank you. Our next question is from the line of from Saili from Old Bridge. Please go ahead.
Yeah, hi, morning, sir. Just a couple of questions from my side. So basically, we have seen our bulk deposit decreasing almost 60%.
Saili, your voice is breaking. I request you to please use your handset.
Yeah, hi. So just a couple of questions from my side. I just wanted to get a sense on our deposits. So basically, our bulk deposits have almost declined by 60%. Any particular reason for that?
Good morning. It was an articulated strategy. We called out much earlier, even before we reduced it. So we wanted to increase our granular sticky deposit. Actually, they are a little more expensive than bulk deposits. Bulk deposits currently, for a similar tenor of 1 year, we will be able to mobilize at around 100 to 125 basis points lower than the granular retail deposits. But it is a conscious strategy. We wanted to really move into granular smaller deposit, which is pretty hard to kind of lay the tracks in terms of increasing the momentum. And bulk deposit, we believe that as and when required, purely from a cost management perspective, we'll be able to kind of accelerate as required. So hence we wanted to increase our retail, consciously kind of increase it, and also given our substantial excess liquidity which we're carrying at close to 1,600 crores in June of last year, we wanted to reduce it even as part of our liquidity management strategy, surplus liquidity management strategy.
Okay. Secondly, on your CVPs, so the gross NPAs over there are quite sticky, or almost 14%, remain largely flat this quarter. So what's your sense on the asset quality there, and on the customer behavior in that CV segment that you're facing? Since we have already seen the cycle starting to pick up. So just want to get a sense on how you looking at it, and what's your customer feedback in this particular segment.
Yeah, as you know that while the momentum has picked up, some segments which were deeply hurt have not really recovered, and part of our NPA is on account of a few transactions to very well established interstate route bus operators. So that I think the reason why it is staying sticky. The good news is that there has been no addition, any meaningful addition to the GNPA accounts in terms of CV. And some of we are able to also see a pullback. Specifically, we saw it during the last quarter. We intend to kind of see the similar pullback. And some of the restructuring which we did in Iraq is also classified in GNPA. Some of them have paid out for the entire year at one specific account, large account, clearly kind of paid out, which will come out of a GNPA during Q1 of FY23. And we have moved away from doing a large ticket CV transactions, which is what we wanted to build to make sure that the loss ratio is substantially lower. COVID really changed that. So we moved into only granular funding, specifically looking at refinance and small vehicle funding at this point of time. The white space we see in CV, where we are sharpening our product, is working capital for mid-sized fleet operators. The large fleet operators have substantial access to working capital funds from banks, by established public sector banks or large private sector banks. The segment between 3 to 15 vehicle fleet operators do not have access to regular working capital except through refinance mechanism. So we did introduce the product. We have around close to 900 customers, around close to 7 crores of outstanding at this point of time. We are working in terms of making it, since we are doing digital transformation to a new IT system, that will be completely digital, and that will be a focus area where it will be white space, very well track record established customers, and our pricing also could be in the range of around 14 to 15%. That will be the focus, and other than that would be in terms of refinance small portfolio. Currently, our run rate at this point of time, cautiously we have reduced it to around close to 10 to 15 crores per month. From peak, what we are doing at around 30 to 35 crores per month.
And lastly, just want to get a sense on so basically our asset quality in unsecured segment has almost improved half the gross NPAs and what it was in last quarter. So was it on account of some collections, or it's written off? How is that?
Both, really. One is that the collection, we have been continuously focusing in terms of customers who are paid in 1 month, not paid for the subsequent month or subsequent 2 months. So as we said that we are kind of, the portfolio remains same, which has not increased. There has been no spillover. This quarter, as kind of guided earlier, is to pull that down by at least by 100 crores on a minimum. But we are targeting around close to 150 crores of customers getting activated. So around closer to around 425 to 450 crores of customers, specifically in the JLG segment, have not paid for 2 consecutive months in terms of November and December. 40 crores of that have paid in the month of January. So our intent is to really accelerate that to around closer to 150 crores. So what we are seeing at an overall broad level, to kind of say that from a GNPA point of view, it is the time stamping. The customer is not paid for 90 days, it gets stamped even if they pay one installment. It is not possible for customers in the JLG segment specifically to repay all the 3 installments and come back to standard book. So while it will linger on as part of the GNPA, our core focus in terms of customer behavior, and as long as the customers are continuously paying, given that the overall tenor of the loans are only 2 years, and non-repayment of a month, and then after 2 months, 1 more month, while it will get stamped as GNPA, they will be, for us, they are regular paying customers, and the intent is to really pull back from closer to 70% of the customer in current bucket, marginally increase it at least by 5% by the end of this quarter. What we are seeing in a broad level, I will tell you that we are seeing far more stability than we saw about 2 quarters back, when even internally guiding ourselves was not very easy. So we see that the behavior stabilizing and improving. And we also seen collections coming from customers who are not paid continuously for 90 days and 120 days. It is not probably just a change in customer behavior. It is kind of planned strategy to reach out to the customer on a continuous basis. For a 2,000 rupees outstanding or a 3,000 outstanding, customer is not going to be reaching out to the institution to repay, and we'll have to kind of take all the efforts to reach out. That I think has been our strategy for Q3, and specifically in the month of Jan, we started focusing on activating, which is clearly reflected in 40 crore worth of customers who are not paid previously for the last 2 months, paying in the month of January.
So how much of our customers in JLG business would be linked, the income would be linked to essential services?
All low-income households, by and large, have multi-streams of income. Were severely impacted were in cities in Bombay, Pune, where there are lockdown in terms of train services getting kind of suspended for a very, very long period. So people in the outskirts like Nalasopara, Ambarnath, Kalyan, where their livelihood, substantial livelihood dependent on coming to work into the city, was impacted. And that's the reason that we saw a little higher stress comparatively in these places. But other than that, in the lower income households, it is just the uncertainty which led to, apart from income loss, the uncertainty also added to the compounded the lack of payments coming in from these segments. I think that's fairly stable now. There is no scare in terms of health, but from an economic point of view, majority of them are tied to things which are essential in nature. Majority.
Okay. Just last one thing. So basically, our other income has declined QOQ and YY. So any particular like lumpy on the base, or it's steady state?
One, I think, to the next thing I know is obviously the treasury income. Requesting Kanishka to add this.
Hi, good morning. The movement has been primarily on account of the mark-to-market on the AFS portfolio. The yields have been fairly volatile, and we have had about 12 crores of hit that we had to take this quarter. And that was the primary reason driving the movement.
Okay.
We also given separately the pre-operating profit, excluding the NPM, which is kind of now around closer to 90 crores.
Okay. Yeah, that's about it from my side. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Nishant Songta from Premji Invest. Please go ahead.
Thank you so much, sir. I had a question on the power book. In fact, just going back to one of the questions asked earlier. Sir, in the third quarter, the power book has sort of increased on a sequential basis. Just trying to understand if third quarter was one of the best quarters on the pandemic and the movement of people and revival in terms of livelihoods, then logically things should have reflected in the power book as well. And this is like about the other MFI players which have reported a decline in the power book for obviously 2 reasons, either organic collections or write-offs. But if you can share your thoughts here, so what really is happening in your operating geography?
I was not able to kind of hear you, but probably whatever I heard, is it if I kind of get it right? But the question is
Sorry,
in terms
may I
of
repeat
the
this,
book has gone up.
Yes, sir.
Yeah. So it did kind of there was certainly a little bit of an aberration, but clearly, as I kind of said, what we are really looking at as one of the core is that at the headline GNPA, NPA, extremely important. The percentage of the portfolio which has not paid for 2 consecutive months is the target. And as I said, that it's in inclusive finance, it's kind of now around closer to 425 crores, and we activated around closer to 40 crores of customers in the month of Jan. That's customers who didn't pay in the month of both November and December, started paying in the month of Jan, is around 40 crores. The intent is to really increase out of this from this 425 crores to closer to around 150 crores of activation. 40 crores has been done in the month of Jan. The focus has to be kind of reactivate, continue to collect from them even in the month of February. The spillover happens on a continuous basis in inclusive finance, as you would saw, which is now stabilizing. That is customer paying in 1 month, did not really pay in the next month, and then coming back and paying the 3rd month and the 4th month, which then takes the customer to 3 EMIs outstanding, gets stamped as a GNPA. So the better picture would be to see our own PAR 90 and the percentage of customers who are paying from the delinquent portfolio. 71.2% of our customers in the 1+ bucket are paying customers. The remaining 30% is what is not a non-paying customer, which is what the value I gave you, which is what we are really working in terms of reducing it by 1/3 during this quarter. Part of that has been done. Of 150 is what we wanted to activate. 40 crores has been done in Jan. The intent is to really do another 50 crores in both February and March.
And Bhaskar sir, did you see any impact of the third wave in January? How are your PAR numbers tracking in January now?
For a few days, it got impacted clearly, around 10 days, specifically in terms of both infection of our own staff, so as well as in terms of not really reaching out to the customer very intensely. So I think the 10 days between 5th of Jan to around 15th of Jan did really impact, but it came back to near normalcy towards the end of the month. Yeah, there was a small impact.
All right. And out of your disbursements in the MFI segment, in third quarter, what proportion would have been towards new customer acquisitions here? Is that also sort of reviving?
Around 1/3 of our disbursements is currently going to new to bank customers. Now again, we are sharpening there and saying that at least we will reduce our reliance on new to credit at this point of time, at least for the next 2 quarters. The focus very well, around 30% of it will come from new to bank. Predominant of that, even by now, around 60% of that is not new to credit. Only 1/3 of 30%, which is around 10%, or little less than 10% is NTC. Cautiously, we want to kind of slow down on this NTC customer into the inclusive finance, at least for the next 2 quarters, this quarter and next quarter, before we see full stability.
Understood, sir. And just lastly, on the Paytm relationship, sir, I just wanted to check with you on underwriting and the loans being originated for you here. Is there a risk sharing arrangement with Paytm?
No, the payouts that we make to them is dependent on the collections that we make. So clearly, we have never did not go into any arrangements in the past or now, or not likely to go into the future as well, where our comfort will be based on the FLDG or the performance guarantees. So, but the payouts in terms of the portfolio generated to the partnerships would be dependent on the collection efficiency over the period of time, not just on a month-on-month basis. So to that extent, it acts as a cushion, but clearly the underwriting and the credit decisioning will be with us. So we kind of own the portfolio and do not do any underwriting purely based on the comfort of FLDG. Don't intend to do so as well.
But if payouts are linked to collections, ultimately, then it's some form of performance guarantee, basically, which Paytm gives, right?
Yeah, it is not a performance guarantee. It kind of gives you a cushion in terms of the collections. Not you have a targeted collections of 98%. So the collection efficiency were to be 95%. So to that extent, your payouts will be lower. To that extent, your earning will be higher, and hence you can say that no, it kind of absorbs the loss pool. It's not a performance guarantee. Performance guarantee would be kind of committing upfront a percentage of the portfolio which will be underwritten directly or indirectly by the partner. In our case, obviously, that excess income which we get, your targeted income is X, and you're getting a little more than that purely because of a reduced payout, which will cushion in terms of any credit losses. What it does is that it kind of makes you take a portfolio which you are really comfortable with, and even in terms of cycles which kind of happens, we are also making sure that we are kind of in funding only in cities where we have our own infrastructure or ability to create an infrastructure as required.
Right. Sir, in that context, the reduction in payout to Paytm, will it cover 100% of your loss on that portfolio, if any?
No. To kind of to get back what you're kind of trying to know is that no, the underwriting is on us. We kind of have our own parameters to do it, and the reduced payout will only absorb part of the credit losses that you will kind of take. So it is not anything closer to what you're really talking about at all.
Okay. All right. Thank you so much, sir. Thank you, and wish you all the best.
Thank you very much.
Thank you. Our next question is from the line of Manav Vijay from Deep Financial. Please go ahead.
Yes, thank you very much, sir, for the opportunity. Am I audible?
Yes, please.
Okay, thank you. So, sir, I just have one question basically. So, from the current run rate of PPOP, monthly PPOP around 35 to 40 crore that we are at, so for next, let's say 2 quarters, quarter 4 and quarter 1, so you will use that money to basically make provisions for the 450 or 425 crores of the portfolio that you have where you have delinquency. And then from quarter 2 onwards, as the credit cost stabilizes, a large part of that PPOP will start to flow down to PAT. Would that be a safe assumption to make?
Let me put it this way. Currently, if you look at our gross NPA to net NPA, the portfolio which is not provided for is approximately around 257 crores. The percentage of portfolio out of the GNPA paying is approximately around 200 crores. So in some sense, it kind of, the portfolio which is paying is equal to the portfolio, the unprovided for portion of the GNPA. The next one is the restructured portfolio. Around 60% of our restructured portfolio is paying, and the intent is to take it to closer to 70-78%, which we called out earlier. And the 60% are kind of not paying, but not necessarily on a consecutive basis on month. The one that gets activated to 70%, which the standard restructured portfolio currently stands at 10%, 11% of our book. Around 40% of that 10%, which is 4% of our overall book, is what we will have to kind of to manage and increase the collection efficiency, or eventually kind of part of that will translate to credit loss. The PPOP that we are making now, which is around close to run rate of around 30 crores, not including the NTM, which we took a 10 crore hit in the quarter, is around approximately, net of that is 80 crores, gross of that is around 90 crores. Around at the current range of disbursements, we expect that it will be in the same range, go to around 90 to 100 crores. So we will have to make provisions out of that probably for this quarter, and part of that will spill over into Q1 of FY23 and FY23 as a whole year. Specifically starting from Q2, we see it as a year of enterprise profit. How much will that be? Yes, mathematically speaking, the substantial lower provisioning should lead to straight PBT, and PBT should lead to PAT. So we are kind of first focusing in terms of reducing this portfolio which is non-paying, and kind of looking at pre-operating profit of closer to 40 crores on an organic basis, not counting for any treasury profits or otherwise.
So, sir, you correct me if I get your number right. So, roughly 4% of the current AUM, which is approximately, let's say, 200 crores kind of a number, is where the problem is. That is what you have to provide for over next 2 quarters, quarter 4 and quarter 1, and then from quarter 2 onwards, it will be normal story.
Yeah, I don't want to kind of go ahead so much. But the question is that out of the 200, the focus is in terms of activating part of that, substantial part of that. How much will it be? We'll kind of get a full clarity in the month of February and March. So not all of the 200 need to be provided for. What you may take? How much of that exactly is the number kind of we'll put in all the execution efforts. Things are far more stable now. They're able to connect with the customers. They're able to reach out to the customer. Yes, I would say that part of that 200 has to be provided for, which is what we have kind of said even in Q2 will be done in Q4, Q3, Q4, and a small spillover into Q1. And hopefully by Q1, we should have kind of provided for comfortably. And from Q2 onwards, I mean, obviously the businesses don't really operate in a pure linear manner. Barring any other thing, that our own organic profit should be higher, closer to 40 crores plus from Q2, which the substantial piece of that should translate into PBT, and part of that obviously is that.
Okay. So my next question is, so regarding the growth rate that you are saying for FY23, you're saying 30 to 35% kind of an AUM growth. If I remember you correctly, in quarter 2 call, you were mentioning, are you actually guiding for around 25 to 30% kind of a growth? So, are you upping your guidance for next year, or so basically, since the environment has become more conducive, you are getting more confidence with your team? So that is the reason why you are upping the guidance for next year?
Partially, yes, and also what we have done about kind of invested in a very intense analytics platform which gives view in terms of our customers, in terms of exposure to various other products, including the track record. That gives us the confidence in terms of deepening relationship with our existing customers. One, the touch point is a lot more easier, the comfort is substantially higher. So the strategy is to really increase the non-microfinance secured business to our existing well-paying microfinance customer segment. And given that the small base and the infrastructure which we created even pre-COVID, which we have not really sweated it out during the last 2 years except for using it for the collection machinery, the growth in business organically should really be a little more higher than what we are clocking for this year. And that leads us to the 30-35%.
Sure. Okay. So, and the last question from my side. So, if I look at it at the quarter 3 balance sheet, you are approximately around 2,400 crores of cash plus investments that you are sitting on. If you can help me with the excess cash plus investment that you are sitting on, basically the cash that is as of now giving you low yield, and which you intend to shift to other high yielding portfolio to basically improve the NIMs without having any kind of impact on the cost of funds.
Good. I'm requesting Kanishka to answer.
Hi, good morning. We have, over the last 9 months, rationalized the amount of free cash available down to 600 crores from a peak of 1600 crores. The natural growth that we are targeting in our loan book will help us reduce this number further over the next couple of quarters.
Okay. Thank you and all the best.
Yeah. Thank you.
Thank you. Next question is from the line of Abhijit Sakare from Kotak Securities. Please go ahead.
Thank you. Good morning. So first is a clarification on slide 21, where we've given a number of 6.4%, which is 90 plus. But on the next slide, on the moment of par, that number is 4.6. So just trying to understand if these are two different numbers that you're reading here.
Yes. Abhijit, I'll come back to you. We just kind of look at the number.
Sure. No problem. So secondly, just to pick up on Nishant's question earlier, the recovery on JLG seems to be somewhat more gradual. Even when we look at the one EMI adjusted collections or the paying overdue customers. So just if you could break it up in terms of is this geographical or a state skew, or is it an urban versus rural skew? If you could give us some broad indicators on that side, that would be helpful.
Abhijit, predominantly we are an urban and a semi-urban player, but however in the smaller towns outside in terms of the 5-kilometer radius itself will become semi-rural and then it will become rural. So around 70% of our portfolio is urban and semi-urban, around 30 is rural. So, and hence the rural behavior on the outskirts probably will not be very divergent from what we have in the urban semi-urban. Since we did restructure the loans and only around 60% of them are kind of paying customers, the spillover happens after the moratorium is over when they come into it. That's where it is steady at around 83, 84. As we activate more, this one EMI adjusted collections is likely to kind of increase. I won't really guide out for how much would that be. But what we have seen certainly in the last 3 quarters is that there is absolute volatility in it. The 84 was not constituted by even 90% of the same customers paying month on month, which trend is what we have started seeing. Around closer to around 10 lakh of our customers continue to be in current. And we are trying to pull in as many customers back into at least current or 1 to 30. So we'll see an increase in terms of this 84%, and the intent is to while it's not a guidance, the intent is to really take it to around closer to 90% by Q1. And some of the but majority of it is all the legacy pre-COVID portfolio, and the activation piece of that will increase the collection efficiency.
And just secondly on this one, what's the normal policy on customers who remain on overdue but ultimately kind of reach the end of their loan durations? So do we look at their near-term track record and renew the lines? How do we kind of treat them? And what happens with the overdue amount which is still left?
The challenge specifically comes in where the entire center and the customers have become inactive, which means that all their installments have fallen due, and then there is no regular installment which is kind of happening. That's a very small piece of the portfolio, but we'll have to be very, very conscious of that number cannot become higher because the touch points then diminishes substantially. So we'll have to keep the customers even before they go out of it activated, or we'll have to have a special focus in terms of what we call as a term close centers, which is that all the customers in that center do not have any installments which is falling due. As of now, it is a very, very small piece of the portfolio, but as it goes, I think we are targeting the existing good customers, which means the centers will continue to be active, and which makes it a lot more convenient for us to keep in touch even with the customers who are not active but belonging to those centers. So that's what we're kind of planning to do this quarter. Good question.
Got it. Thanks. The second one is on Paytm. Is this a merchant loan? If you could just tell us what sort of a loan are we sourcing for that?
It's merchant loans for customers who have been kind of having relationship with Paytm for a period of at least 6 months, and they are all for business purposes. and we are not into any consumer lending to them or into, we are not just with Paytm, with any partner, we are not into BNPL or consumer loans. They are only business loans for merchants. And the average ticket size is around closer to 2 lakhs.
2 lakhs. And what would be the yields, the card rate on the product?
The net of payouts, the rates will be around closer to 12 to 14%, depending on the size of the loan, the credit score of the customer, multi-factors, but the range is 12 to 14%. Net of payouts.
It's a fixed rate loan for the.
They are all fixed rate loans. Yeah, they are EDA loans, equated daily installment loans.
So just to understand this better, so the customer, so the loan is sourced on the app, right? So you've reached an agreement with Paytm where they are able to pick up customers in your geography and kind of offer them a loan where you are the lender at the back end, because it may not be a pan-India relationship, right?
No, it is not a pan-India relationship. It is for specific cities. Majority of the cities are operational. Some of the cities where we are not fully operational, we have the ability to put in the collection network as and when required. Currently, the entire servicing, sourcing, partial servicing and collection happens through our partner. But as and when, and we also visit those customers as a sample, it around 15 to 20% of customers are met post-funding, just to align that what we are intending to do and what we are doing is exactly on the same page. Credit decisioning is done by us. They do the shortlisting, whitelisting. The final credit selection based on the credit scoring is done by us. So there is a limited loan which we give to new to credit, but the rest of it by the track record of the customer, including quite a few of them even have secured loan track record. So they are not necessarily new to bank. Majority of them, or partial of them, are new to credit, which means that new to the banking system.
Sure. And sir, finally on this one, like we had an unsecured business loan product which had like a 30-35% delinquency, and this one probably has a similar customer profile. So do you think having a payment relationship materially changes the tendency of default? If you have any thoughts on that, please.
Yeah. See, the measurement of delinquency on a rundown portfolio will not be a reflection of the quality of the portfolio. So we put it on pause during the pandemic that we didn't want to increase the portfolio, hence what the number. But on an ongoing basis, what we saw at that point of time was around closer to 10% delinquency. Had we continued on an overall basis, the credit losses in that business would be around closer to 5 to 7%. And there are obviously, we started the product new, there are quite a bit of a learning. One of the key learnings is that in terms of the stability of either the residence or for the shop, if there is a ownership of it, then the track record is very different. There is a delay, but there is not a credit loss. But if both are kind of rented and they are new to credit, that I think is a risky segment, which we don't do. We are restarting it with our own experience in terms of when digital, but in a specific geography. Also, it's very important that when you're doing on our own with our own collection machinery, the geography has to be sharp, it has to be deep, rather than spreading outside. Even in a city like Mumbai, you can't say that we are operating in Mumbai as an entire city. You have to pick the pockets because the potentials are so large. Done well, I think the credit losses would be in the range of around 5 to 7% max.
Got it, sir. This is super helpful. Thanks a lot.
Thank you.
Thank you. We have the next question as a follow-up question from the line of Renish Patel from ICICI.
So before that, just kind of clarify to Abhijit question in terms of 90 plus. Over to Kanishka, please.
The differential that you observe between the two numbers is largely on account of the 93 crore of write-off that we have taken in this particular quarter.
So you're not adjusted it more. Yeah. Thanks, Abhijit, for pointing out. We'll do that. That's a correction. Over to you.
Yeah. Renish, please go to the question.
Yeah, thank you. My questions has been answered. Thank you.
Thank you. We'll take the next question from the line of Pritesh from DAM Capital. Please go ahead, Pritesh.
So one question on the restructured book, we seem to have a 25% type of a provision coverage. Any plans there to increase the coverage ratio? And second, how much do you feel that will not slip into NPA?
We are not. These are all reschedulements done in touch with the customer, requested by the customer, and we also did where at least they paid one out of the previous 3 installments. So touch points established, behavioral pattern reasonably established. So intent, even when we are doing, was to really kind of activate at least closer to 80% of the customer. 80 to 90. Across the industry also, we are seeing the range of around 70 to 80% of the restructured customer have started paying, not necessarily on a month-on-month basis. Currently, we are at around 60%. The intent for this quarter, with a focused effort in terms of getting them active, because there is a moratorium, there is slackness would have set in terms of touch points and then following up with the customer. As it gets activated, as installments are falling due, the intent is to really take it to at least closer to 70-75%. We will have full clarity, visibility of it, what we'll have to provide for in RC by end of March.
So that is when the majority of the portfolio starts paying, right? Because I assume that restructured would have ended at March 31st last year.
No, we did restructuring even in September.
Okay, sure. And second question basically was on the borrowings. I see the borrowings being a little bit higher this quarter. Any specific reason?
We had borrowed 750 crores in SLTRO window, which is at 4% fixed for a 3-year period. Since we had excess investments, we leveraged that to reduce our cost of borrowing and consequently the cost of funding, which is where you see the drop from 7.1% was the cost of funding and cost of deposits last quarter. Currently, the cost of deposits continues to be 7.1 on an overall portfolio basis, but our cost of funding has come down to 6.8.
What is the tenure average on this one? 3 years?
3 years fixed 4%.
Sure. And so this was one of opportunity from. So how do you feel on the deposit side, especially the CASA? I mean, the CASA is slightly slower. Do you feel that we'll see some more traction on CASA going forward?
Our articulated CASA strategy is in terms of focusing on granular CASA, specifically on the SA piece, and not really price that SA anywhere closer to our fixed deposit rates. So we did we've been reducing the rates to ensure that what we get is accounts which are having flow, which is leading to float. And we also said that we see a CASA increase happening gradually, quarter on quarter, and our target one is to really increase it by 1.5% on a quarter on quarter basis. So what we are aiming to in terms of build on the SA platform predominantly is in terms of retail granular SA, which will lead to a reduced cost of deposits rather than an increased cost of deposits or maintaining at the level. So we again reduce our pricing by effective of in January. Our current overall, I think, cost of CASA would be less than around 5%.
Yeah, around 5%.
Sure, that is helpful. Thank you, sir.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you for joining in. As said that we are glad that we are able to have a lot more visibility and stability coming in back into the sector as a whole, and specifically for us as a bank, we have seen a good traction in retail liabilities, our cost of funds coming down, and our overall cost to income ratio is stabilizing, and we see that coming down in the quarters. Our focus will be in terms of strengthening a relationship with our large customer base who have exhibited excellent prepayment behavior and the ability to manage the cycles through COVID 1, 2, and 3, which gives us hope that we'll be able to maintain, build a very substantially good sustainable portfolio, and we should be back in terms of reasonable profitability track starting from Q2, and we see FY23 as a year of a meaningful enterprise profit. Thank you for your support. Thank you very much. Have a great day.
Thank you very much. Ladies and gentlemen, on behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.
Thank you.